Hello and welcome everybody. Welcome to the Texas REIAs. We're going to do a live broadcast tonight for you guys online. Welcome online, and for you guys live, welcome live. So this is the Texas REIAs. The Texas REIAs is the largest by far network of real estate investors and investor associations across the great state of Texas, with chapters in Austin, Dallas, Houston, and San Antonio. And the reason that matters, the reason you might care, should care, is because real estate is local, and laws are local, and rules are local, and neighborhoods are local, and buyers and sellers are local, and money and power teams and everything you need to be a real estate investor is local. So the saying is, if you have even the slightest interest in real estate, the very first place to go is to your local real estate investor association, and that's how you get plugged into a vast community of people that are actually doing this stuff. So we've been doing it for 20 years. This REIA's been here for 20 years. And the REIA, Real Estate Investor Association, provides resources to the community. What kind of resources? Money, training, market data, market updates, power teams, just about everything you could ever need, and then some, vendors to be a real estate investor. And we're going to kick off this particular meeting by giving you a market update. We're going to tell you what's going on in the real estate market so that you can be a student of the market. And then we're going to talk about which strategies to use in this particular marketplace. I will say this is data that's pulled from places like the Texas A&M School of Real Estate. We are not here to try to sell you something or to provide or try to persuade you of some particular mindset. And by that I mean, when the market's going up, we say it's going up. When the market's going down, we say it's going down. And we even give you some data, and we even give you a forecast. There are certain groups out there that always say, oh, the market's going to go better, it's going to get better, or whatever, because they're trying to convince you that it's a good time to invest in a certain thing or whatever. We just give you the data, we'll give you a forecast, but we tell everybody, your job is to be a student in the market, because whether the market's going up, down, or sideways, there are ways to make money investing in real estate, and you need to be a student of the market to know where the market is. So welcome. We're going to talk about where the market is and what's going on in the market. What's the big story with real estate over the last couple of years? What's the big story? What's that? Interest rates. Interest rates. What happened to interest rates? They went up. They went up. Okay, so interest rates went up. Okay, so they're different than they were. So let's talk about that. So who thinks that interest rates are high? Raise your hand if you think interest rates are high. Who thinks interest rates are low? Interest rates are low. Okay, you only get 2 votes, okay? So it's like 1 or 2. So who thinks interest rates are high? Raise your hand if you think interest rates are high. Who thinks interest rates are low? Raise your hand if you think interest rates are low. I got 1 low and a bunch of highs. All right. Well, I mean, by the way, it's opinion, right? I mean, your opinion can't be wrong, right? I mean, it's just opinion. My opinion, interest rates are normal. Okay, that's my opinion. I have been investing in real estate for 20 years. I have a portfolio of rental properties, for example, about $30 million worth of rental properties, and most of them are financed with interest rates, with mortgages that are 6.5% to 7.5%, because that's normal. And I got them when things were normal. Now, a few years ago, there was a period of time where things were very abnormal. Interest rates got all the way down to 3%, which is not normal. Before that, when was the prior time that interest rates got down to 3%? Does anybody know? That would be never. It never happened in your parents' lifetime, in your grandparents' lifetime, in your great-grandparents' lifetime. When do you think it's going to happen again? I have no idea. But if I were to guess, never in your lifetime, your kid's lifetime, your great-great-grandkid's lifetime. And the world that would have to happen to make that happen, I don't know if you would even want to live in that world, because you'd probably be more worried about getting bullets for your AK-47 than you would about interest rates in the world that would cause that to happen again. But we don't know. We don't know for sure what's going to happen next. I always tell people I don't know what's going to happen. I know it's going to be different, and I do know that, but I don't know exactly what's going to happen. But certainly for sure, they went up compared to what they used to be. And they're now into the range that I consider normal. Personally, as a real estate investor for 20 years, I like normal. I prefer to invest in a normal market than to invest in an abnormal market. And I'll give you like an example of that. I do both residential and I do commercial. So I invest in both, active and passive. And in commercial real estate specifically, a few years ago, and we do all kinds of commercial. We do RV parks and mobile home parks and assisted living facilities and hospitalities and storage and on and on and on and on, including multifamily apartment buildings. So a few years ago, multifamily was hyper competitive, super competitive. And so people were buying these apartment buildings at top dollar. And they could pay for it. They could pay for it because they financed it with a 3% mortgage. So at 3% mortgage, even at top dollar, they could still collect enough rent from the tenants to pay the mortgage. But here's the thing about commercial, everything about commercial. Commercial loans are not 30-year loans like residential loans. Commercial loans tend to be 5-year loans, right? These are from small local banks. The deals tend to turn over every 5 years. The investors, they don't want to put their money in for 30 years, they want to put their money in 5 years. So these deals constantly turn over. So all these people bought these, right, multifamily properties at top of the market, right, top dollar. They financed them with 3% mortgages, and they got 3% mortgages so they could collect enough rent to be able to pay the mortgage. But then what happened? The interest rates went up to 7%. And all those properties are selling, and if you bought them at the same price that the last guy bought them at, right, and then you got a 7% mortgage, the numbers don't work. They don't collect enough rent, right? So there's a lot of deals that are falling apart. And the reason they're falling apart is because they bought something abnormal, right? And that's why I prefer normal. For the last few years, I've been asking people that are doing syndications, I said, what are you gonna do when interest rates go up to 15%? And everybody's like, that's ridiculous. They couldn't go up to 15%. Does anybody know what interest rates were in 1981? 18%. So don't tell me they can't go up to 15%. You know, when they're 3%, I know they're not going to stay at 3%. I don't know where they're going to go, but I know that was not normal. And that's why I don't like normal. I just don't like to invest in something that's abnormal because you can't count on it. You know, Wayne Gretzky's famous quote, I don't skate to where the puck is, I skate to where the puck is going. Well, if you're doing a commercial syndication, a 5-year deal, you have to ask yourself, what's the world going to look like in 5 years? And you have to make a pretty good guess about that. Would I guess in 5 years something that's never happened before in the history of civilization will happen? No, I wouldn't guess that would be a reasonable bet. Would I guess today that we have 7% interest rates? Would I guess today that in 5 years we'll have something in the ballpark of that, maybe even a little better? I would guess that that's a pretty good bet, okay? But you don't know. So yeah, interest rates are higher though. And it's a perspective thing. You know, for somebody that's been investing for a long time, like 20 years, they would say interest rates are normal. If somebody was investing back in 1981 and they look at the interest rates right now, they'd say, oh wow, money's on sale, it's cheap, right? If somebody's only been kind of paying attention for the last few years, they'd say, oh, interest rates are high, right? And it's just perspective. So, but they're certainly higher than they were, that's for sure. So when interest rates go up, what happens to home prices? Okay, I'm going to give you 2 votes. When interest rates go up, who thinks home prices go up? When interest rates go up, who thinks home prices go up? Okay, when interest rates go up, who thinks home prices go down? Okay, I got a bunch of downs. Okay, so I would say they go both up and down. You see, here's what you're going to learn about interest rates. Real estate doesn't really care about interest rates, surprisingly. Real estate cares about 2 things, supply and demand. All it is supply and demand. Okay, now interest rates go up, more expensive for sure, so there's less demand. Less people can afford to buy a house because they're more expensive. The payment is more expensive. That's true, so demand has gone down, but something else has gone down, the supply. Why? Because historically, 2/3 of the houses that are on the market for sale are resale, and 1/3 are new construction. Right now it's inverted. Right now 2/3 of the houses for sale are new, and only 1/3 are resale. Why? Because nobody's selling their house. Why? Because they don't want to lose their 3% mortgage and buy another house to get a 7% mortgage. Normally, the economy's not bad. Normally, people would be moving up at this point. They'd be like, time to get a nicer house, right? But nobody wants to sell. And because nobody wants to sell, all that inventory is getting held off the market. Something else is going on a national basis. How many of you have heard this? We are in the middle of a housing shortage. Who's heard this? Yeah, we have 6 million fewer houses than we have people that need a house to live in, right? We have a constricted supply for a lot of different reasons. We'll talk about those reasons, okay? And when you have a housing shortage, less supply, right, that pushes prices up. Now, why did they raise interest rates? To battle what? To battle inflation. So when most people talk about inflation, they talk about it in negative terms. I always hear that. Inflation is bad, inflation is bad. I disagree. I personally love inflation. I adore inflation. I go to bed hoping for more inflation. I have another name for it. You know what I call it? I call it appreciation. Yeah, same thing, guys. When the money becomes worth less, what becomes worth more? Physical stuff, right? Gold, real estate, right? Everybody knows that. Get your money out of money. Put it in physical stuff because the physical stuff costs more, i.e. is going up while the money's going down. So if you own $30 million worth of houses and you have a bunch of appreciation, then you celebrate. Ooh, I'm excited. My portfolio and most people's homes went up more than 30% over the last few years because of inflation, appreciation, right? So it's a perspective thing. Now in 2002, 3, 4, 5, 6, 7, right, the banks came up with this idea called subprime lending. Remember that? Anybody could get a loan. If you wanted a loan, you walked into a bank, they held a mirror under your nose. If they saw fog, you got a loan. So everybody got a loan. And builders built houses out over the horizon in every direction. They built bazillions of houses, and they gave everybody a loan, whether they had job, credit, income, anything. They just gave everybody a loan. So they built bazillions of houses, and they gave out money like it was candy, and everybody got a loan. And then in 2008, what happened? Crash. The banks went bankrupt. Well, they were too big to fail, weren't they? So we bailed them out, but they went bankrupt. And lending just came to a stop. It didn't slow down. It was like a train hit a wall. It just stopped. So you had all this supply, and just like that, no more demand. And then what happened to the real estate market? Crash, crash. Now, after that, eventually the banks got back into the lending business. And all these years later, today, what do you have to do to get a loan? Turn over your firstborn, fill in a 1,900-page application, submit blood samples. A lot. You got to do a lot. You see, money got cheap, but it never got easy. And because it never got easy, right, we haven't been building enough houses. And that's why we have a housing shortage, right, which is pushing prices up. So we have things pushing prices up, and we have things pushing prices down. And when you put it all together, I'll show you where we are. But let me start by showing you a really interesting chart. This is one of my favorite. This is interest rates versus median home prices going all the way back to 1970. From 1970 to 1981, there it is, interest rates on mortgages got all the way up to 18%. And you know what happened when interest rates went up? This little red line down here, that's median home prices. Median home prices actually went up. And when interest rates came down, you know what happened to home prices? They went up some more. And when interest rates went up and down, up and down, up and down, home prices still went up. Now there were some bubbles. There was a big bubble. That was that 2008, 9, 10 bubble, remember? And there's some little bubbles. So there have been some bubbles. But it's not as simple as like interest rates are up and home prices are down, right? Because they're pushing things up and they're pushing things down at the same time. So where are we? Well, what happened in 2021, prices went up a lot. In 2022, they went up a lot more. And then in 2023, it flattened out. So the market went flat. Didn't go up, it didn't go down. Now, the volume went down. What does that mean? Yes, it's more unaffordable, less affordable, because houses are less affordable, there are fewer people that can buy, so there are fewer buyers. But that's offset by the fact that there's also fewer sellers. And when you have fewer buyers and fewer sellers, then what happens to prices? They're going somewhere in the middle. And what happened all of 2023, they went flat. They've moved a little bit in 2024, and I'll show you that in a minute. Going to the Texas Roundup, these are state numbers, and then we'll dive into some of the different cities. The average price house in Texas is, what is that, 429,000, down 0.4%. It's basically flat. And median price house in Texas, 345, down 0.8. It's basically flat. Months of inventory. This is the importantest, the most important number to look at. Months of inventory. What is months of inventory? That's what you want to look at to know what's really going on. Months of inventory says this: if you only took the houses that are on the market for sale and you just didn't add any more houses for sale, you just take what you got, don't add any more to the market, how long before the shelves are empty? How long before they'd all sell? And the answer is 4.6 months of inventory. Now, to put that into perspective, the saying is if there's less than 6 months of inventory, you have a seller's market. If there's more than 6 months of inventory, you have a buyer's market. If there's right around 6 months of inventory, you have a neutral market. By historical standards, we still have a little bit of a seller's market. Now, it's not as strong as it was a year ago, for sure, because a year ago we had 3.2 months of inventory. But we're still technically in a seller's market. I would say we went from a strong seller's market to a weak seller's market. Going back a few years, 2021 prices in Texas went up 18% in 1 year. In 2022, they went up another 10.7% in 1 year. 2023, flat. It just flattened out, not up, not down, although the volume is down. Number of buyers and number of sellers is down. Houston. Houston looks a lot like Texas. Average price house in Texas, in Houston, 432, up 1%. Median, 345, also up 1%. Months of inventory, 4.4 months. Lease prices are actually up a little bit. When lease prices are up, that's a commercial data point. What does that tell you about vacancy? Is it high or low? They're fully occupied, right? When they're getting low occupancy, then prices go down. 2021 months of inventory, 4.4 months. Not bad. Not as good as it was a year ago, but not bad. 2021 average price went up 16% in 1 year. 2022 up another 10%. 2023 flat. Just flattened out, flat, flat, flat. All right, Dallas, DFW, the big D, second most expensive city in Texas. Average price house in Dallas, 518, flat. Median price, 413, flat. Months of inventory, 3.7. It's actually the strongest market in Texas. Not as strong as it was a year ago at 2.5 months of inventory. 20% up in 2021, 15% up more in 2022. 2023, it just flattened out, up 1%, which is flat. Leases down 1%, lease prices are up 1%. Basically, the leases are flat in Dallas. And that gets us to Austin. Now, Austin is an outlier, and I'm going to tell you why. But the average price house in Austin is $578,000. That is not a typo. Down 5% over a year ago. Median price, what is that, 490 something, down 6%. Months of inventory, 5.8 months. So what's the outlier here in Austin? 2021 is the outlier. In 2021, prices in Austin, Texas went up 29.3% in 1 year. That happened in 1 year, 2021, and we're still recovering. In 2021 in Austin, Texas, it was normal in that abnormal year for there to be 0.4 months of inventory. We had less than 2 weeks of inventory. It's never happened before. In 2021 in Austin, Texas, you put a house on the market, you would get 11 offers in a weekend. One would win, and 10 would lose. So the 10 guys that lost would put an offer on a second house. They got 11 offers in a weekend. One would win and 10 would lose. And this would happen over and over again until the buyers would start screaming at the realtors, "What's wrong with you? You're giving me bad advice. I need to buy a house. I keep getting outbid. What do you have to do to buy a house around here?" And in that very abnormal year of 2021, in that abnormal year, it became normal for people to buy houses at 5 to 10% above appraised value. Do you know the bank will not allow you to buy a house above appraised value? The total down payment and the total loan cannot exceed by $1 the appraised value. If you want to buy a house above the appraised value, you have to bring extra money. After the down payment, after the loan, you got to bring extra money to pile on top of all of that. Okay, and in that abnormal year of 2021, people were buying houses for 5 to 10% above appraised value. 2022 didn't get much better because prices went up another 10.4%, and then in 2023 it went down. So in most of Texas, it went up 30% and it flattened out. In Austin, it went up 40% and came down 10 and flattened out. So perspective. If you have owned a house for 3 years, congratulations, you made 30%, no matter where you were. If you own a house in in Austin, a year ago it went down. That's perspective. And then we have San Antonio. The average price house in San Antonio, $372, most affordable market in Texas, down 2%. Median is flat. 4.9 months of inventory, arguably the weakest major market in Texas. 2021 prices up 16%, 2022 up another 12%, 2023 flat, really down 2%. So where are we going from here? Well, let's look at what's driving the market. The overall economy is not bad. It's pretty good. Now, real estate doesn't really care about the economy. But if the economy is doing badly, people feel less confident and they're less likely to buy a house. Consumer confidence, same thing. Consumer confidence is measured on a 0 to 200 point scale. And it's just like, how confident do you feel? Anything over 100 is considered confident. Anything under 100 is considered unconfident. So we're right now at 102, kind of right in the middle, just over the middle, not bad. Unemployment. Anything below 5% employment is considered very solid. Texas is less than 5%. It's 4%. So we have good unemployment. Again, people are a little more likely to buy a house. Job growth. We are continuing to create jobs. And if people have jobs, they're a little more likely to buy a house. So that's pretty good. Stock market. Now, again, stock market doesn't really affect real estate other than psychologically. If people's 401ks went up, they feel a little wealthier. And if they feel wealthier on paper, they're a little more likely to buy a house. So that contributes in a positive way. And then, of course, we have interest rates. Interest rates got higher. And when they went higher, fewer people can afford a mortgage. So that reduces the demand. House price trajectory is pretty much flat, not really going up, not really going down. Closed sales trajectory down a little bit, so that's a little bit of downward pressure. Pending sales trajectory also pretty flat. Active listings also pretty flat. Months of inventory, we're still less than 6 months of inventory. So we're still in technically a seller's market, although it's a pretty weak seller's market. And inventory is growing. Housing permits trajectory. We are building more houses, but we're barely keeping up with demand. And this is probably the biggest bullet on the page. I should make these different sizes. These are not all the same size impact. This would be a big one. I should make this like a triple size bullet. Remember, real estate cares about two things, supply and demand. So migration is one of the most important factors. Migration is the ratio of people moving in versus people moving out. Population change. And where's everybody going? They're still going to Texas. You know, last year, California lost 500,000 people. Last year, Texas gained 500,000 people. Where do you think they went? Yeah, I think so. So yeah, people keep having babies and keep moving here, and then there's like 11 million other people. We don't know where they came from, we don't know where they went, but we probably are safe to bet a lot of them are here, and they all need a place to live. So that's driving demand up. And then finally, we have like construction labor growth. That's another factor to consider. What is going on there? Contractors are dying. They're getting old. The average general contractor is like 58 years old, and the kids are not taking up contracting. So if you have a kid, right, like a teenager, don't send them to college. Buy them a hammer. Yeah, I'm serious. They'll make crap loads more money. They won't have to work for some jerk, and they'll be so much happier, right? And they really will. I mean, contractors are making a fortune, a bloody fortune. I heard this story recently about this surgeon, and his toilet got all stuffed up, and so he had to hire a plumber to fix his toilet, and the plumber comes in and fixes the toilet and hands the surgeon the bill. And the surgeon's looking at the bill like, oh my God, this is ridiculous. This is the kind of money a surgeon charges. And the plumber says, yeah, I used to be a surgeon. Okay, yeah. I used to be able to build houses for 100 a foot, and then 120 a foot, and then 150, 180 a foot, and then 200 a foot, and then 220 a foot. Now you're lucky if you can build a house for $300 a foot. It costs a fortune. And most of it's labor and then a fair amount of materials on top of that. So it's getting really expensive to replace the houses, and that's a factor. And then we got a little election going on. I heard there's something going on over there. There's a few wars going on. We don't know where inflation is going from here. So we got some things pushing up, some things pushing down, some things pushing sideways. Okay, what do you think, guys? Let's ask everybody's opinion. Who thinks prices are probably going to go up? Who thinks prices are probably going to go down? Got a mix. Got a mix. Oh, somewhere on there was interest rates. Interest rates are forecast to start going down. We don't know. But the last Federal Reserve report said we're probably going to drop it 1/4 to 1/2 a point by the end of the year. Will that happen? I don't know. If that does happen, that will tweak this one, which is a big one, you know, pushing things down. So I think that would really help. So forecast is not much is happening, right? Interest rates should drop by about 1/2 a point by the end of the year. Sales is coming up a little bit, but not really much. We expect prices to be flat to up 3 to 5%. There's things pushing up, there's things pushing down. We don't expect a whole lot to change in a big way, and that's kind of the forecast. We do publish all of this on our social media. We update this every month. I will say that I don't create the data, I'm just reporting the data, but we've been doing a forecast here at the Texas REIAs for 20 years, and it's always been pretty darn accurate. And I'm not saying we're geniuses, I'm saying this is not that hard. Like predicting the economy, I think that's really hard. Predicting the stock market, I do believe that's absolutely impossible. Predicting real estate, not that tricky, because it's supply and demand. And the truth is, we know almost everything. We know exactly how many houses we have. We know exactly how many houses we're building. We know pretty much exactly how many people we have. We know how many people are dying. We know how many people are having babies. And we know about how many people are moving here. So we know how many we got. We know how many we need. We know just about everything. There's a few little things we don't know, like will interest rates go up and down or whatever by when, but there's not a whole lot of things that we don't know. And that's why we know a lot, and it's not that hard to make a forecast. All right, any questions on all that? Was that helpful for you guys? Yeah? Any questions?